and welcome back to the MCF Participant Education Series. My name is Hunter Nighbert, and I'm a financial advisor and retirement planning specialist with MCF Advisors. And this quarter's education topic and webinar is 401k versus IRA. Today, we're going to compare and contrast 401ks versus individual retirement accounts and lay out the differences between the two and pros and cons as well. And uses for both of them. First, let's start with what is a 401k. A 401k is an employer-sponsored retirement plan. 401k plans typically have higher contribution limits than most of the IRAs out there, but not all of them. When an employee signs up for a 401k, they usually specify a percentage of their income or a dollar amount from each paycheck to go directly into the 401k and or an investment account. Sometimes employers of 401ks offer a match, meaning that your employer might also make contributions via percentage or a dollar amount into the retirement account as well. There are a couple of different contribution types between traditional or pre-tax 401ks and what's known as a Roth 401k contribution. Let's start with the pre-tax or the traditional contribution. A traditional 401k contribution is made with pre-tax income and is tax deductible, meaning that it's subtracted from your income as far as paying taxes when the year is over is concerned. So you avoid tax up front. It goes into the account. It grows tax-free. You can make changes without any taxable consequences. And upon withdrawals at 59 and a half or above is the typical normal retirement age for 401k. At 59 and a half and above, when you take withdrawals, you will pay taxes based on any amount of withdrawals combined with other sources of income upon doing that. So to review, a traditional 401k contribution is tax deductible, meaning you avoid tax today, and you will pay taxes based on how much you take out in a given year combined with your other sources of income in retirement, if that's when you do it. A Roth 401k contribution is made with after-tax dollars, meaning that it gets taxed today. It goes into the account, grows tax-free. You can still make all the changes that you would like along the way without any taxable consequences. However, when those funds are withdrawn, those dollars are tax-free when you withdraw those later in life. One significant difference is that you can withdraw contributions on Roth 401k to the extent of what you put in, meaning your contributions themselves, not the gains, as long as you've had an account for 5 years or more, Roth dollars for 5 years or more, you're allowed to take those out penalty-free. Not recommended, but something that is available. Really, you should consider the pre-tax contributions if you think that your tax rate will be lower in retirement than it is today. If you're in your peak working years, then I would definitely say that you might be better off taking a pre-tax contribution today, and you can definitely benefit during that period of your life by lowering your current taxable income. I think Roth contributions are really great if you have a long time to invest, meaning that you're younger in age. I'm a big believer that Roth dollars are better in the long run. If you believe that your tax rate in retirement will be higher than it is today, then Roth dollars probably make sense for you. And if you also think that taxes will ultimately go up in the future, then it might be better to put those in at a lower tax rate today than, again, paying the same moving forward. I would say with this, with Roth dollars, given the same amount of percentage, Roth dollars do provide more replacement income than pre-tax dollars do because of the tax-free status especially when given a horizon of 10, 12 years or more. Now let's talk about an individual retirement account, otherwise known as an IRA. What is an IRA? Well, it's an individual retirement account. It's a long-term tax advantage savings account that individuals with earned income can use to save for the future. IRAs do have tax advantages with them. Money held in IRAs usually can't be withdrawn before 59 and a half. And RMDs, meaning required minimum distributions from traditional IRAs, must start at the age of 73, even if you are working. So RMDs while you're working in a 401k are non-existent, but in IRA, the required minimum distributions do kick in. Types of IRAs include a traditional IRA, a Roth IRA, which is just the after-tax contributions. There are phase-in and phase-out limitations on both of those based on your income, if you're allowed to continue with that. There's also known as a SEP or a Simplified Employee Pension IRA. This is typically for people who are self-employed looking to save more than what normal traditional IRA or Roth IRA limits allow. Also known as simple IRAs is another type, which allow for incentive match for employees if you own your own business. Now, traditional IRAs versus Roth IRAs are kind of similar to the 401k. On a traditional, contributions are tax deductible up front. So you pay taxes when the money is withdrawn based on your income. Then if you take it out before 59 and a half, there is a 10% penalty for accessing that, the same as there is on a traditional 401k. If you're not 59 and a half, don't do that. Find other ways to get the money. Don't raid your retirement savings. And then no taxes are paid on the account while they're earning, just like the others. And there's very little income restrictions when it comes to that. Roth IRAs, on the other hand, are used with after-tax dollars. They're not tax deductible. Money is withdrawn at a tax-free basis after 59 and a half, or if you've had it open for 5 years, you can withdraw it out to the extent of your contributions. And no taxes are paid on the earnings. The earnings are tax-free as well, as long as you're with age as that. There are income restrictions. High earners generally are disqualified for saving in Roth IRA. The other thing that's important to know is that you can contribute to both your 401k and IRAs. Some people might max out a 401k and then go to an IRA to kind of stretch those out. And so that is a really nice advantage to be able to max fund and save both. And you can make tax advantage contributions to both sides. I would say this, the pros and cons. 401ks are usually lower cost in nature because of the group dollars at work. So 401ks in general are better designed instruments for accumulating those assets, I would say. So that is definitely a benefit. If you're not going to max out all of your dollars, then I would definitely take advantage of your 401k plan, because it's usually cheaper and you can put more in it. Also, when it comes to 401k, the fund choices and investments are usually lower cost because of the group dollars at work as well. So while you're accumulating those assets, 401k tends to be a little bit better. As least of today, when it comes to the distribution phase of life, so getting to retirement and starting to withdraw those dollars out, generally 401ks are not as conducive to that because of fee structures. There are more fees to taking distributions, and you're also subject to the rules of the plan itself in terms of taking distributions. IRAs, on the other hand, generally have lower fees in terms of you can set up automatic distributions on a monthly basis with no fees. So at least as it is today, IRAs tend to be a little bit better when pulling your money out. You can also have more options in terms of investments when it comes to creating more fixed income opportunities. Sometimes that can be very advantageous to do that in the IRAs. But no right or wrong with each of those in terms of that. 401k is a little bit better while you're saving money. Today, IRAs, I think, are a little bit better than, when it comes to taking money out. But not necessarily. Each plan has different fees. So we have to look at those things at a more specific level when it comes to that time. Really, in conclusion, take advantages of the resources available to you. Understand the differences in 401k and IRA. Use those differences to your advantages when it comes time. If you have questions about any of those type of things, then I would really encourage you to schedule a meeting. Shoot me an email. This is my information on the screen. Feel free to scan that QR code, set up a one-on-one meeting with myself or another team member possibly assigned to your plan. Let's really get down to the brass tacks and figure out what's best for you on a personal level. As always, take advantage of it. We're here for you. We're here to help you and really facilitate a better outcome for you as you save for retirement. That's all the time I wanted to take today. Thanks so much for watching. If you found this information useful, then I would encourage you to like, share this video with colleagues, friends, and family if you feel need be. That's all for today. Until next time, you all have a great summer, and we'll see you soon.